Okay, let's unpack this. We're diving deep into how one of the oldest industries out there, insurance, is, well, fundamentally resetting its strategy using artificial intelligence.
Mm-hmm.
We're focusing on the engine room of sales,
Mm-hmm.
specifically how AI is predicting probably the most valuable metric in the whole business, customer lifetime value, CLV.
Yeah, and this is really more than just, a software update. It's a complete strategic pivot. Insurance sales, historically, they've been about volume, right? Broad-based leads.
Get as many names as possible.
Exactly. But now, with predictive CLV modeling, insurers are using some incredible computing power, not just to find customers, but to figure out exactly who their high-potential, long-term, most profitable clients are likely to be.
So our mission today, it's focused on two things for you, the listener. First, we need to extract the mechanics. How does the AI actually do this? What goes into building that forecast? Some surprising inputs there. And second, we really need to zero in on the specific, quantified benefits. We want to know exactly what kind of measurable results insurers are seeing when they actually deploy this stuff.
And the underlying goal here is to show you how this massive shift happens, moving from that kind of generic wide net outreach to really intensely personalized engagement, how that maximizes long-term profitability and, frankly, transforms what we even mean by a successful sales interaction.
Right.
We're moving the industry away from guesswork, toward these really granular, data-driven decisions.
Okay, so let's start with the core problem AI is solving here. In the insurance world, historically, a sales team might put huge effort into prospecting a lead,
Uh-huh.
who maybe signs one small policy and then they churn 18 months later. Or maybe they stay, but they're always a low-value client. It just felt like a high-effort, low-yield process, a lot of wasted time.
And that's precisely why AI tackles the prioritization problem. It helps focus effort where it actually matters most. So when we talk about CLV prediction, what we mean is the process of forecasting a customer's total expected financial contribution, their long-term profitability to the company.
Okay.
It's about analyzing, decades of potential revenue versus the decades of potential risk.
And the engine driving this is machine learning, obviously.
Okay.
But we need to get past the buzzword. What specifically is the AI feeding on? What data fuels this forecast? Is it just simple historical averages?
Oh, not at all. It's way more complex, mostly because the data inputs are so diverse.
Yeah.
The AI definitely feeds on deep historical data. That includes the obvious things: purchase history, policy renewals, demographics.
Standard stuff.
Standard stuff. But crucially, it also analyzes claim frequency and severity. That's absolutely fundamental for assessing risk and predicting those long-term loss ratios.
Okay, but if they just stop there, that sounds like standard business intelligence, maybe a bit more sophisticated.
Hmm.
That doesn't quite explain the big jump in predictive accuracy we're hearing about. The source material really highlights that for this to work well, the model has to handle nuance. Which brings us to the non-numerical inputs. And here's where it gets really interesting, I think.
Yes, this is the crucial differentiator. Natural language processing.
Yeah.
NLP. See, when you're modeling profitability, you can't just rely on what a customer did in the past, like renewing a policy. You have to try and assess what they might do next.
Okay.
So NLP evaluates customer interactions, think emails, chat transcripts, maybe even notes from recorded calls. It looks for sentiment and intent within that language.
How does that actually map to dollars and cents, though? I mean, analyzing millions of transcripts for sentiment, that sounds computationally expensive. Does the ROI really justify adding that complex NLP layer compared to just, say, sticking with historical renewal data?
Oh, absolutely does, because NLP can detect those really early signals of churn that purely numerical data often misses entirely. For instance, if a transcript shows a customer repeatedly mentioning a competitor by name, maybe asking questions about their rates, or maybe their sentiment score drops sharply right after they call about a minor policy change, NLP flags that. That behavioral cue becomes a predictor, a high probability flag for imminent churn.
Ah, so the AI is essentially connecting those dots, linking aggressive price checking or clear dissatisfaction, or even just curiosity about competitors. And it translates that qualitative stuff into a quantitative churn probability score. It's finding those subtle behavioral tells that come before the actual policy lapse.
Precisely. And it's that blend, the hard financial data, the specific claim history, and these behavioral signals pulled from NLP that creates the really accurate high-fidelity CLV forecast. And that predictive score, it isn't just some nice-to-have metric. It immediately translates into massive, tangible benefits for the sales team on the ground.
That makes a lot of sense. Knowing why someone might leave is just as valuable as knowing when they joined. maybe more so. So let's talk about the change in behavior then. What happens to sales teams when they get these scores? Before we hit the big conversion numbers, what's the single biggest, maybe psychological or structural change you see in how they work?
I'd say the biggest change is focus. And honestly, morale. Think about like a junior agent. They used to spend maybe half their week just cold calling lists, right?
Yeah.
Lists generated by standard marketing, maybe based on geography.
Yeah, dialing for dollars.
Exactly. Now imagine that same agent logs in and gets maybe 5 leads a day. But these leads are pre-vetted, they have a high CLV score attached. The agent knows these are likely high-intent, lower-risk prospects. That's a game changer for their job satisfaction and effectiveness. It moves the role away from random outreach towards targeted consultation.
That absolutely shifts their approach. They're not just selling anymore, they're advising, consulting.
Okay, let's get to the numbers now, because this is where the value proposition really hits home, especially for anyone listening in an executive role. The goal is enabling sales teams to prioritize and engage much, much more effectively.
And the measurable uplift is pretty significant. When sales teams focus on those high CLV customers using hyper-targeted outreach, meaning the agent's time is spent only on the most promising leads Ubers, insurers are seeing conversion rates jump by up to 20%.
Wow. 20%.
That's a massive operational improvement just from smarter filtering up front.
A 20% boost in conversion just by changing who they talk to. But okay, the initial sale, that's only half the battle in insurance, right? You've got to keep that customer for the long haul to realize that lifetime value.
Absolutely. And that's where the personalization driven by the AI insights kicks in. Because the system understands the full risk and loyalty profile, insurers can craft much more tailored plans. The sources specifically mention bundled policies as a key tactic here, like home and auto together.
Exactly. Or life and health. Based on the predicted needs derived from all that data, offering these custom-fit bundles and plans, that increases customer retention by a very notable 15%.
Okay, so better targeting gets them in the door, better personalization keeps them there longer. But what about pure efficiency? Insurance sales can involve a ton of manual effort, paperwork, high-touch processes,
Yeah.
huge internal resource drain.
Right. And the automation that comes with streamlining that whole prospecting process, it leads to enormous efficiency gains. Agents aren't manually sifting through CRM data anymore or trying to qualify leads based on simple demographics. The AI system handles that heavy lifting. That efficiency gain alone is leading to a cost reduction in the sales process of around 25%.
25% cost reduction plus a 20% higher conversion rate. I mean, that is the textbook definition of profit optimization. So if you pull all these levers together, the targeting, the personalization, keeping people longer, and this massive operational efficiency, what's the overall impact on the top line, on revenue?
Well, if we connect this to the bigger picture, you've got the 25% cost reduction happening at the same time as the increase in conversion and retention. What we see is that identifying and focusing on these high-value clients can consistently drive somewhere between a 10 to 15% increase in overall sales revenue.
What's fascinating here, I think, is how the efficiency gains aren't achieved at the expense of growth. That's often the trade-off with cost cutting, right? But here, it seems the resources saved from that 25% reduction are channeled directly into those highly profitable interactions the AI flags. It paints this really strategic picture of optimized profitability. The cost reduction actually fuels the revenue growth.
Exactly right. It's smart scaling. And it's precisely why this kind of AI technology is quickly becoming, well, a competitive necessity. It's not just an optional tool anymore.
Okay, let's pivot now. Let's widen the lens a bit and look at the industry-wide impact and maybe where this tech is headed next. This is clearly transforming the market, but what does the immediate landscape look like today?
Yeah, it's definitely far from being a niche application. There was a 2025 report confirming that insurers who are currently leveraging AI, they're achieving an immediate and pretty substantial 30% improvement in their sales targeting accuracy.
30% more accurate target.
Right. And that level of precision completely changes the competitive dynamic. It makes rivals using traditional, broader methods look, frankly, quite wasteful by comparison.
And crucially, this isn't just happening in one corner of the market, is it? It's impacting strategies across the board. Auto, home, life insurance. The whole sector is being pushed toward this data-driven customization.
That's right. Every major player seems to understand they have to get smarter about who they're selling to and, just as importantly, how they're engaging them.
So the current state is impressive, 30% better accuracy. But what's next? Where does the evolution go from here?
Well, the immediate future trajectory seems to involve even deeper data integration. Right now, many CLV models still rely heavily on historical or somewhat static data, the claim history from the last 5 years, that kind of thing.
Yeah.
Looking just ahead, the AI models are set to integrate much more high-frequency real-time data. The goal is to achieve even more agile and precise CLV predictions, adapting almost instantly.
Can you give us a specific example of that real-time data? When you say high-frequency real-time, what kind of external signals are we talking about that could possibly impact an insurance CLV score on the fly?
So the source material specifically mentioned leveraging things like social media trends and other external data streams. We're talking about real-time indicators like maybe frequent status updates about buying a new house or selling a car or even significant job changes.
Life events, basically.
Exactly. These aren't just idle details online. They signal immediate potential policy needs. A new home likely requires higher coverage limits, right? A new car changes the risk profile. A job change might signal a shift in disposable income, which affects loyalty patterns or ability to afford different coverage.
So it moves beyond just looking at historical patterns.
Yeah.
It starts incorporating immediate behavioral signals that forecast not just long-term risk, but potentially immediate need. The AI could dynamically reprioritize a lead list based on someone's social media post from an hour ago.
That's the core idea, yes. That's the outcome they're driving towards. And this capability, it leads to genuinely dynamic sales strategies. It creates a much more customer-focused sales approach because the offers and even the timing of the outreach are constantly adapting to the customer's immediate circumstances and their projected future needs.
If we connect this to the bigger picture then, this kind of integration, it moves the whole process from static prediction, where maybe you forecast CLV once a quarter or something, to dynamic strategy adaptation. Your entire sales approach could literally be changing day by day based on these real-time signals. It almost transforms the insurer from just reacting to claims into more of a predictive partner for the customer's life changes.
That's a great way to put it, and that's a competitive advantage that, frankly, can't be easily replicated with standard data analytics alone.
Okay, so wrapping this up, what does this all mean? We started by saying AI is revolutionizing sales, and I think the data we've discussed really provides undeniable proof. The AI uses that blended input, deep historical data, nuanced NLP analysis to accurately forecast profitability. And that leads to these dramatic, quantified improvements we talked about. 20% higher conversion, 15% better retention, driving up to a 15% overall revenue increase, all fueled by those massive efficiency gains. It really means that highly personalized, highly efficient targeting, it's rapidly becoming the baseline, the industry standard for profitability.
And that leads to a really fascinating final thought we should probably leave you with. Building on this idea of dynamic strategy adaptation. If AI can get so precise at predicting long-term profitability, analyzing claims, renewals, and this real-time social media intent data that changes almost hourly, well, it raises a pretty profound question. How will the very definition of customer loyalty change? We've traditionally defined loyalty based on historical behavior, sticking with the brand over time. But when insurers are making these real-time dynamic strategy adjustments based on immediate social signals, that customer relationship becomes incredibly fluid. It seems to demand constant data-driven engagement from the insurer rather than just relying on static past performance. The data moves so fast, maybe loyalty becomes less about history and much more about the quality and relevance of the insurer's next predictive move. Something to think about.